My name is Eric Wilkinson, folks. This is Pro Trader Strategies website, and we are doing a webinar on, yes, I'm going to remember, folks, for those who have been sticking around, know that I have a habit of not sharing my screen. This is the options guide, and we are going to be cracking the code to trading options, all right? I'm going to build from simple concepts in this video to real-life examples, and for some of you folks that have been sticking around and gone through a few of these webinars, I've got some new stuff kind of tucked in here for you guys, so it won't be the same old thing over and over. All right. We are always constantly looking for different strategies with this. I want to not only talk about what I think is the most important aspect of trading options to understand, but also bringing that into connection with each option strategy. We'll look at those different option strategies and peel back this onion in order to discern what we're looking at here. All right, so we're doing the short call today. With that, we've talked about a few things. I'm not going to jump right into the short call. It is a high risk strategy and unlimited risk strategy, but we can kind of peel this onion back, and I'll show you how the probabilities really prove this strategy to be a relatively low risk strategy, only based on the probabilities. So before we get there, first, let's talk about this. It looks like it's raining, right? And when we're trying to look at these numbers and discern if it's an O or a 1 or a 0 or a 1, it's completely changing constantly. But what this is representation of is the transfer of data. This is the fastest way to transfer data. And when we're looking at this, it's because it is so streamlined that it's able to do that so quickly. But let's make it simple. Let's screenshot this. Let's slow it down just a little bit and break it down to zeros and ones to make that simple. And when we're looking at this at the option montage level, where all of these options are trading, the prices are jacking back and forth in front of our eyes, and it feels like sometimes you're looking at the inside of an airplane fighter pilot's cockpit. All these things are jacking back and forth, and you don't know if you're in a tailspin or taking off, right? Well, with that, I hope at the end of all of this, we will go from like the streaming aspect of the data transfer to where we can actually snapshot this down and really take a look at it and say, hey, I can tell the difference between a 0 and a 1 now. All right, now we've all been through this, and this is really having to do with price discovery, right? And that's something constantly we are doing as traders. It's a price discovery, meaning, well, where do I find value versus where somebody else finds value is really what that comes down to. And sometimes when I'm thinking I'm buying low, somebody else is selling high. And that's just like with a house. We've seen what's happened to housing prices recently. They've gone straight up, right? Well, we've also seen in the past where the dollar signs have gone down. The housing market has been all over the place. In 2000, let's say in the early 2000s, right? When we were talking about the 2000s, housing prices were skyrocketing. And then we got up to about 2008, and what happened? Well, we lost my pen. They free fell, right? So people that were buying here thought maybe they were buying low, but they surely were not buying low. We found that out at the bottom of the financial crisis. And we've seen the markets kind of rally back and forth, and there's a bit of fluctuation going on. But for the most part, we have seen houses, for the most part recently, move dramatically higher. So are you buying a house low now, or are you buying a house high, right? That's the real conundrum, is trying to figure out what is buying low and selling high. When we look at charts, it makes it a little bit easier sometimes, right? We can see on this chart where low is. Maybe that was on the IPO day. Sorry, I lost some of my stuff there. Thought I got my pen going. So easily find buy low, right? And definitely the high watermark would be the sell high. But most chartists will kind of find that bottom where you can find the support level where it comes down and hits the ground, and then draw in another, excuse me, I'm ready to sneeze. I can fight it. But on the upward trajectory, we can see where it loses momentum. So on a simple chart that is always trending sideways, maybe like IBM, which is a really good example of a sideways trending market forever. This is a pretty easy one to figure out, buy low, sell high. But on markets where it is in an upwards trajectory, where is the buy low, sell high? Well, some of you chartists might draw a line in there and say that's it. But that's not always the case, because it goes down lower, and it could even go down lower, right? So with stocks, it's all about price discovery, not necessarily buying low and selling high. I mean, it is such a novel idea, but what does that mean? Buying low, sell high? Really what we should be talking about is buy high and sell higher. And Joe Terranova quoted that, so I can't steal it away from him. He even wrote a book like that. But that's really what it feels like we're doing constantly, is trying to discern, hey, is this buying low or selling high? So it's not as cut and dry as a lot of folks would like you to believe. You know, we could look at it, for instance, where, you know, something starts out here, and the easiest example I can think of is maybe on an IPO day, and you didn't have the opportunity to get involved, right? And all of a sudden the market shoots up, and you're thinking, God, I knew I wanted to get in that thing on the IPO. Pulls back a little bit, and you're thinking, you know what, I got to pull back, I'll buy. You know, it's never going to go back down to the IPO start. It's, you know, XYZ stock, and then it shoots up. Maybe you sell, maybe you don't, but then it corrects, and you're thinking, oh, I'm back to where I was. You probably aren't buying, probably not selling. We talk about this as, you know, there's a psychological level to trading where when you've transacted the same price quite often, there's not as much angst to get in and out at those levels. So for this person, they might stay in it. And it gets a little bit of a pop, doesn't quite correct. And what happens? Goes down to the IPO. That's usually a place where people will puke and sell out. Well, as simple as it sounds, buy high, sell low, or buy high, sell low. That's usually what happens, right? So a buy low, sell high doesn't always work, and we don't always know. We might have thought we were selling high here. Is this selling high if I think it's going to continue to go lower? Yeah. I mean, it's really all about what our mentality is in this trade, right? So while it's simple to say all you need to do is go out there and buy low, sell high, it doesn't often work that way. But when we're trading options, these options have a tell. They give us a tell whether or not the pricing is cheap or expensive. So for instance, you know, we can use the option platform to discern if something as simple as this pin is cheap or expensive. Or, you know, if we're looking at Tesla and I'm bullish, well, I don't know that the stock is cheap or expensive right now based on the price, because that's all forward earnings and multiples based on their current earnings, which doesn't really give you a clear picture as to the value of this company down the road, 10 years. We don't know. I mean, some folks thought Kodak was going to be around forever. Kodak, if you guys don't know, is an old film company like Fuji, and didn't make it through the transition to the digital stage. So folks thought that Kodak, being one of the biggest companies in the world at one time, all of a sudden cratered. So pricing on forward multiples doesn't always give you a clear picture. But options, I believe options will show you when they're cheap and when they're expensive, because volatility looks like this. And volatility for an underlying is pretty range bound. Now, when I'm talking about volatility here, I'm not talking about the VIX, folks. The VIX gives us a broader overall arching picture of volatility in the markets, okay? This is a culmination of all of these underlyings, individual stocks, volatility, and how we're trading those options, and that's what's driving the VIX. It is a basket of all of these. But when we go down and look at volatility for XYZ, ABC, PDQ, or whatever, what we're trying to do is look at the volatility chart, and it will look like this, because the underlyings will have a tendency to have a sideways trending market where we can see relative extremes and relative weakness, if you will. or lows. Okay. Now, over the course of several years, you might think, well, hey, that doesn't pan out. Well, I'm going to show you it is pretty close in line. And for some of you folks that have been watching these videos in the past on the webinar days, then you know that volatility looks like. If you watch the spotting the trades, you guys definitely are very accustomed to talking about volatility because that's my hyper focus here. So it will have a tendency to break out of those range sometimes, but you can see this is a relatively sideways market, right? And it doesn't matter what stock it is, all right? If I'm looking at XYZ, I need to look at XYZ's implied volatility, all right? And where it is in relation to its own past, all right? I'm not looking at VIX and saying, hey, options over there in Apple are really expensive. No, because I don't know if volatility is affecting Apple right now. It could be like this one where the volatility is coming out. That would actually be putting downward pressure on, adding to downward pressure in the VIX, okay? So this does feed into that data, but we want to strip out all the other garbage that we're not looking at, all right? I need to know what this underlying coefficient is, all right? And right now it's around 30. And we can see that up here at around this extreme level, I would say it was probably up at around 50, right? Well, if I flip over to another chart of, say, let's just say Tesla, I mean, I don't know where if I even have a chart of Tesla, I probably don't, but let's just take a look at a chart of Tesla. And we'll see that Tesla's 60 is kind of in the middle. And does it ever get down into the 30s? No, probably not. And that's probably the first time I've seen Tesla get down into the 40s there. Usually it's very elevated, all right? It even usually has a one handle, like a 1 point something here. So volatility follows Tesla. But then you could go over to something like, I can't think of a utility right now. All I can think of is UAL and only type Under Armour. But UAL, as you can see with the airlines, this coefficient is all over the place. So you would have to really have a wide swath for this one. So again, a reason why you wouldn't compare UAL's volatility to ABC's volatility. Now we've stretched this out for 3 years on this chart here, and we can see that over 3 years even it stayed within that. Yeah, we had a pandemic in there. We've kind of forgotten about that, right? Maybe not completely forgotten about it, because you can see that the bottom, the low water mark, if you will, is a little bit higher than it was pre-pandemic. But since the pandemic, there's been a lot of tension, and we're continuing to see tensions globally in and around what's going on, right, with Russia and China. So we're staying a little bit elevated. So one of these things that I like to do with this chart is I look at, for one, the last year, because I know that this underlying usually has a pretty solid range that it's going to be staying within. And then what I'll do is I like to narrow it down, even especially right now in this time, is to narrow that time frame down to about 6 months. All right, a year would be the longest I would really look at it. And I actually have the script. I've written the script so that you can throw it over if you have a Ameritrade or Thinkorswim, to put it over in the watch list so that it gives you a gauge as to whether implied volatility is high for that underlying or low for that underlying. Generally speaking, what I say to do is throw in your brackets. Now, if you have a lower risk tolerant appetite, or if you are newer to trading options, maybe stretch it out and where the tips just hit your line. I like mine to pierce through a little bit. For one, when it hits that line, I like to start thinking about strategies I could implement. And then especially if it rolls, I see it rolling back into the channels here, then that's when I'm going to get a little bit more aggressive, because as it's coming into the channel, I'm expecting it to go just like a chart, go touch that bottom line in the sand, right? That's what we usually do as chartists, is look at it hitting those support and resistances. That's what I'm trying to do similarly here with implied volatility, and it works. All right. So again, well, I don't know why I did a double chart there, but again here, one of the things we could say is we draw the line in this on the tips here, and you try and take the tops. Let's just actually, why don't I use my pen? Because it's not very good. All right, so draw a couple lines there, right? So if it's on the bottom line, you know premiums are super cheap. And if it's on that top line, you know those premiums are expensive. Now, a lot of folks will be out there and saying, hey, you know what? If you go further out in time, they're really expensive too. Well, yes. They're more expensive further out in time because you have to pay for the time to be in this trade, all right? You have to pay for that opportunity when you're buying an option. And then when volatility starts creeping up, we see all of those premiums. It doesn't matter if it's further out or nearer. All of the premiums across the board will creep up. Puts and calls will go up as volatility goes up. It doesn't matter what the underlying is doing. It could trade sideways. It could not even move a penny. And if volatility is fluctuating, we would see the premiums fluctuating. All right. So ultimately, what we want to have happen is to have these premiums fluctuate in our favor. And the only real way to do that is if you are buying options, is to buy them low. And if you're selling options, you want to sell options when volatility is at the upper band. All right. And, you know, what I usually talk about is draw your line right there, you know, a 50% line, if you will. And the sell zone is up here and the buy zone is still down here, but below anything below 50. Now, newer traders, maybe you split it up into quarters, which I have no problem with. As a matter of fact, I've championed this several times in the past, so this is something as well. So if you're newer, maybe you want to wait for those extremes to sell at the extreme areas up here and buy down here, and then just say, you know what, I'm going to leave that to the pros or till I get a little bit more comfortable. Okay. So maybe you look at it that way for selling options and buying options. So we're clear. Volatility drives prices. As a matter of fact, I got a great example coming up for some of you folks that are sticking around that we can show how this volatility can drive price. All right, so I was taking a look at Nvidia. In my daily morning commentaries, which are spotting the trades, I go through you know, all the economic data and stuff like that, and then talk about how that's going to all impact the markets, and then round it off at the end of the webinar with some options that I'm going to be looking to trade, or underlines that I'm going to be trading around. So I've been talking almost till I was blue in the face for the past couple of months about the correction in the NASDAQ versus the Dow holding on to some strength here. We might see some flight to quality, if you will. Well, with that said, Nvidia's real market has been driven by the miners of cryptocurrencies. All right. They're one of the main companies that produces the video cards that spins off all these coins. Well, if we've seen what's happened to Bitcoin lately, it seems like most of these cryptocurrencies are cooling off just a little bit. We're not seeing the volatility. And we're also hearing that these crypto guys are struggling to make money, the miners. They're basically spending exorbitant amounts of money on electricity to produce a coin in the hopes of producing a coin, really. So those folks are struggling as well. So that if everybody's hearing they're struggling, what's your likelihood you're going to go out there and drop $50,000 on a mining operation for your cryptocurrency and spend $10,000 a month in electricity in the hopes that you're going to get one Bitcoin? Probably not everybody's cup of tea for taking risk. All right. So with that said, I think that Nvidia has an opportunity, especially with NASDAQ and the volatility we're seeing there. If NASDAQ starts correcting, it's going to draw down a lot of these big tech type names, even if they're not even in the E-mini S&Ps, folks. It will start pulling them down. So with that said, I was looking at this as volatility is pretty high. It's above that 50 mark for me. Volatility looks like it's coming out. So another thing, let's think about this. If volatility is high and we believe volatility is going to come out, what is the first thing that comes to your mind about the premiums? The premiums will start going down, right? And if those premiums start going down, we don't want to be a buyer. We would want to be a seller of that, right? If we expect the premiums to go down, we want to sell high and buy low. Sell first and then buy low. So expecting volatility to come out. And my thesis on this trade is it's pretty weak because of Bitcoin, lack of follow through. It's right there at the point of control, which is what I was talking about earlier, where when you are used to seeing price trade, you know, the point of control is the psychology of the market where we've all transacted and we're accustomed to seeing $222 for Nvidia. How many times have I traded $222 for Nvidia? I've bought and sold that 100 times, you know. So when we see that trading all the time, folks aren't as interested in buying and selling at that price. Pretty simple, right? It doesn't feel like you're getting a bargain and it doesn't feel like you're selling it really expensive. So people have a tendency to tuck their hands and sit and wait, which is another thing that could bring volatility out of this trade. So if it stays right here and trades sideways, well, volatility comes out, those premiums come out of the options, okay? So, but my thesis is I think that the market's going to roll over or trade sideways, right? I see volatility being high. It's a sell zone, all right? Now, if I am in a sell zone, what's something else I might want to have happen? Well, before we get there, let me start real quick. I'll let you guys think about that. All right, so let's go over this real quick. I'm going to trick you into it. All right, Delta, folks. Delta, everybody talks about Delta, and I'm not going to talk about Delta the same way, so you don't need to just hang up. Make sure you smash that like button when we're done with this little phase here, because you guys are going to all of a sudden have light bulbs going on. All right, so Delta is changed, the rate of change to an option, okay? I'm fine with that. Basically meaning when we're looking at an at-the-money option, being the options contracts that are basically right in the middle of the road. Let me try and find out. So the at-the-money options, make sure. All right, so these are at the money, meaning the underlying is trading 45. So this is 45, that's at the money. Those are usually the ones that are very close to 50. They should be 50. The puts are not, should be higher than 50 with folks buying puts, hopefully. Anyway, so the at the money ones are usually right around 50. All right, so I'm going to say that that's 0.50. I don't want that to mess me up. No, go back. All right, 0.50. All right, you got to be kidding me. It's going crazy. All right, 0.5. Ah! Oh, my Lord. Can I have the pen, please? Final answer. Pen. Got it. Doesn't want to write. All right, 0.50. Those are the at the money, just to give us an idea. Now, what this means is for change in the premiums, it means with the options, we always look at options as options with the one rule is that with options, the Greeks assume, sorry. Sorry, I had a brain fart there. I was like, I don't want to write all this out, and that's all I could think. So options assume an increase, all right, or an advancement, meaning if I'm looking at Delta, it's assuming a dollar move higher, okay? So with that said, on an increase of $1 is what Delta tells us. So if the underlying increased by $1, my premiums associated to this 0.50 delta would increase by 50 cents, all right? And vice versa. You have to think of it on the flip side. If we go down, that's negative, right? So a negative plus a positive would make that a negative. So if the underlying started moving down, this would make it a negative to my position, okay? Does that make sense? Meaning if the underlying starts going down, a negative plus a positive delta would mean that my premiums decrease as the underlying decreases. All right. Sorry, I have allergies going crazy right now. Gamma. Gamma is simple. It just goes with delta. Goes with delta. And usually what we're going to see is something like nickels and dimes on this one. And this is on dollar number 2. All right. So dollar number 1, delta increases my premiums by 50 cents. On dollar number 2, gamma goes with delta, and then it would increase by 55 cents. Does that make sense? So on the first dollar, I would have gained 50 cents to my premiums. Second dollar move higher, I would have gained 55 cents to my premiums. Okay. On the call side. On the put side, they're negative, so they would have decreased. All right. And then thief. Like, you guys are like, there's no thief. Yes, there is. It's called Theta. Theta is the thief in the night that comes and steals your premiums, folks. All right. And I'll tell you, Theta is much less aggressive further out in time. All right. So if you are thinking you are buying options, you need to be thinking further out in time. Because when you are buying, do you want somebody to take pennies and nickels and dimes out of your jar? Right? No. You want to limit it. You want to maybe take a penny and beat it. Take a penny, beat it. But if he's grabbing nickels and quarters, that hurts, right? So stay away from that. Further out in time, Theta is much less. And I like to say, basically, if you're looking at greater than 70 days to expiration, that's your buy zone. That's where Theta is really limited. You want to start outside there, all right? And then basically, less than 35 days to expiration is the real sweet spot, I'm going to say, to be involved, like to actually have your trade on, sweet spot. But, you know, I will stretch it out to less than 45 days. That's kind of like, if it's outside of 45 days, that's where I'm kind of like, all right, I need to go in closer, maybe to 20 some days, okay? So stay inside of 45 and know the sweet spot for Theta is right around 35 to really ramp up. Outside of 70 will give you enough time to limit that Theta decay probably throughout the duration of your trade, which is usually going to probably last, a couple of months maybe. So it'll help you stay away from that. So we've got delta is the rate of change to our options premium. Gamma goes with delta. Theta is that thief in the night that steals your premiums, and he is really aggressive the closer he gets to expiration. All right. He doesn't want to leave a penny on the table. And then finally, we've got Vega, which is just implied volatility. That's that little chart we were talking about. Why did they call it Vega over in the option montage? I don't know. Probably because they wanted to be all cheeky and say that they were naming it a Greek like the rest of the Greeks, Delta, Gamma, and Theta. Well, there is no Vega in the Greek alphabet. It is just a fugazi Greek. But anyway, Vega increases says that as it increases 1 percentage point, then the premiums are affected to that coefficient. All right. And now no, Vega affects further duration options more. So I like to look at it as if I'm going to see an explosion in volatility, I want to be buying out further out in time, right? I want to buy out there, and Vega affects further duration options, limits my Theta decay. That's how you turn the tables in your favor in trading options, is knowing these simple little things that folks on TV, even guys that I've respected throughout my trading career, still say the wrong strategy in the given environment that they're talking about. All right. Meaning they will be buying calls when volatility is through the roof for that underlying. All right. Now they have a different fiduciary responsibility being on TV. So know that that's part of the equation here. All right. But when volatility increases 1 percentage point, our premiums increase by the corresponding volatility coefficient, and vice versa. When it decreases by 1 percentage point, then our premiums go down. okay? Dollars go up, premium or down, okay? So as it fluctuates, premiums are fluctuating constantly. Now notice that I didn't say anything about price. Price has nothing to do with this. The only thing that affects this Vega is that volatility moving. The underlying moving up or down does not, okay, affect Vega. Now, one might say, some of you guys that are really savvy might be going, oh, you just blew it. You just blew it with me. You just said it doesn't. Okay. There is a bit of a caveat, a nuance to Vega, that it does have a tendency to spike when we see the underlying go down in value. And the reason why, that's a product of folks going out there and buying puts with unabated consequences. They aren't thinking logically that they're buying puts and they're paying through the nose for the premiums. They don't know that they've got to look at volatility to determine if they're cheap or expensive. All right. So you could buy puts on the expectation the underlying is going to go down, and it does. Maybe it goes down really fast. And you bought those puts and you're thinking, I'm going to make so much money. And then volatility drops right out of the floor. Because you bought it such high volatility. It could completely offset the entire trade. I've got a small example of something similar to that today. Not quite that dramatic, but I've seen it happen. And believe me, it will if you set yourself up improperly. So now you don't have to worry about the Greeks. All right, let's go back into this with real life examples, building on those simple concepts, right? So let's go into the option montage. This is what I'm talking about when we're talking about the option montage. It sometimes looks like it's just going crazy in here, right? But I'm going to try and make it so you can focus in on what needs to be known. So we've got delta, gamma, theta, vega. Delta, gamma, theta, vega on the put side, right? And we talked about this. This is all about an increase on our rules, all right? Whether it's $1, a percent, or a day, right? Theta is a day advancing. All right. So when I was talking about delta here, that means that this is going from 222 and it increases by $1, right? So now we're at 223.03. Let's make it exactly $1. All right. So on that first one, this goes into the premiums. 50 cents goes into those premiums. On dollar number 2, now we're at 224.03. Now, gamma goes with delta. This increased 51 cents. So we were basically, let's just call it right in the middle of 50. So if this is in the middle and at 750, right? It increased to $8. And then gamma goes with delta, and then actually this would be 801 because it's 51 cents. And then gamma goes with delta on the second one. So now we've got 53 cents going in here. So now we would, on that second dollar move, have our premiums be at 3, 4, 5, 6, 8.55. All right. So see how that happens? First dollar move, second dollar move, gamma goes with delta, and then jacks it up again. Now, let's just quickly look over here at the puts. We're not doing puts today, but just know, here's where I was talking about the negatives. All right. Theta is always negative. All right. Theta is always negative. Why? Because you can't go back in time, folks. Still, unless you've got a DeLorean that does. Vega is always positive, right? We got Vega is always positive, and it jacks up when we see premiums jack up. All right. With the volatility. And then theta. If we look at theta, look at how aggressive theta is inside of like basically 10 days to expiration. Further out in time, we can see that incrementally doesn't really increase until we get inside of, what did I say? The sweet spot of that 35 days to expiration. And you can see that theta really starts ramping up as we get closer and closer to expiration. So is it me or is it blurry? Is it a blurry screen? I'm not sure. I hope not. It kind of does look blurry on that thing over there. Let me see if this clears it up. Is it still blurry? It does look a little blurry, but I'm looking at a super tiny thing there. All right. So when I'm looking at options and I'm selling calls or selling anything really just naked short, all right? One thing we talked about with Delta, it tells us all kinds of things. And most folks will drill down on, all right, it's the rate of change to your premiums, okay? Because that's just the simplest thing to come up with, I guess. But really, another aspect of Delta is it tells us the probabilities. It tells you your percent chance of being in the money, all right? Now, a lot of people get this wrong. It's only being in the money by 1 penny. It doesn't mean that it is in the money at the same level you entered, okay? So it just means that it has that probability of being in the money, meaning a 30 Delta has a 30% probability of being 1 penny in the money on this expiration date, okay? Just 1 penny. That means a 90 Delta option says there is a 90% probability I will be 1 penny in the money at expiration, meaning that I'm worth 1 penny only, okay? So those probabilities are a little bit deceiving sometimes, that folks think it's pretty locked up. It's pretty locked up. It's going to be in the money, but what is its value at that time, all right? And the same goes for probabilities on the further out options, right? I talked about the 50-50 option, all right? I like the 16 Delta-ish option, all right? Because that's a full 1 standard deviation move away on a bell curve, which I explained in other videos. I'm not going to really beat that dead horse in this one. But what I want you to come away with here is that this strike for this option, the 265 call, has a 16% probability of being 1 penny in the money at expiration. Not very good odds, right? A 16% chance of me getting thumped. Well, those are pretty good odds. Basically, 8.5 out of 10, I'm not. So those are great odds. So that would be why I'm looking to sell that strike, is because of the low probabilities. It really comes down to the risk reward, what you're going to receive for another option. If you go out to like a 10 Delta option, it's only got a 10% probability of being in the money, but your risk reward on that kind of trade is you're literally only picking up nickels, all right? At least when you're at the 16 Delta, it feels like you're getting a nice chunk of change for taking the risk, okay? So anytime you're selling options, folks, that a lot of people will focus on the fact that you are putting up too much risk, all right? Selling options is too risky. But when I talk about buying options and the risk involved in that versus the probabilities, then it kind of changes that whole conversation, doesn't it? Like if I said, go out and buy a 16 Delta call, it's a limited risk strategy that you can make a ton of money on, but you only have about a 16% probability of success. Are you going to put thousands of dollars on a 16% probability of success? That's like going out and betting at the racetrack on the worst horse in the field every single time. All right. You're buying it. That's why gambling places are so rich, is because they're sellers. All right. Why are insurance companies so rich? Because they're the sellers of the premiums. While on TV and everything else, and all these people that are supposedly financial gurus say that this stuff is too risky. Huh? I don't know. To me, the risk seems differently. All right. It seems higher risk to be buying a 16 Delta because the probabilities of success are almost nothing. All right. So that's the way I look at it. So when I'm looking to sell options, especially covered calls, if you own this underlying Nvidia, I think right now is a great time to be lowering cost basis on all stocks you have in your portfolio. You should be I think you should be selling calls, lower cost basis. If it gets called away in this bearish, crummy market we've got going on, sell the puts. You're getting paid to stand in front of the train now. You know, when people go out there and put bids in the markets lower, like maybe I want to buy Nvidia at 200. Why would I put an order in to buy 100 stock of, or 100 Nvidia at 200. It's silly. Why wouldn't I go out there and sell like the 200 put and get a collection of premium? And if it goes down there, then I get to buy it. And if it doesn't, I get to keep a dividend, or however you want to look at it. So I look at this 16 delta, not quite the 16. I will default further out as well. And here is your risk reward on this. You're only going to collect $260 for every one contract you do. Probabilities of success are 85% here. 85% probability I'm going to keep $260. All right, there's a 15% probability I could lose some money. But keep in mind, as this underlying, even if this underlying starts rallying against me, if I can find my chart, let's just pull up a chart. Even if the underlying starts moving higher, all right, for like this is a perfect example. Why is it changing when I'm hitting my pin, folks? Oh, I know what happened, because I thought I was going to draw it. I can't draw on that screen. All right, so this is an example. Look at this. So the market shot higher. All right, we could say that this went from basically, let's say 42 even from the bottom here, $42 to $46 on a move to the upside. You know, in the meantime, we saw this volatility drop. Look how many points. That's like 7 to 8 points. So like 8 times whatever the volatility is. Would all of that be offsetting this little pop in the market? Quite possibly. It happens a lot. I could have bought calls on this bullish move. The market rockets. I think I'm a genius because it goes back to the point of control where I know it's going to settle down. In the meantime, volatility came out and I didn't make any money because they set it up at the wrong time. All right. So volatility is high. We look to sell. We want to collect a premium around that 16 delta. All right. And your risk reward is you are risking more than your reward, quote unquote. Now, when I'm trading though, I'm looking at getting out at certain levels. Like I would be getting out at looking at this 65 strike right here, because that's a long way away. So I'd look at the Fibonacci around that 65 handle was what I was looking at for this trade. Another reason why I kind of rolled out to that further delta from the 60 to the 65 was because I was like, hey, there's another little fib up there. And now remember, my break even on this trade, I want to sell it at 265. I collect $2.60. That collection I get to keep no matter what. So I add that to 265. My break even is 267.60 now. So I have a lot of wiggle room to be right. Oh, wait, it's the wrong one. I wanted to get out my Nvidia. Right? So I had yesterday this resistance and this resistance, and I got a little ahead of myself here showing you guys the love trading. What's that, Dr. Dari? I don't know. I doubt it. I thought that was somebody I knew too. Anyway, so the market is starting to correct there. So what happened? One thing we can see here, what happened to my thesis of volatility coming out? It hurt a little. Well, what happens when markets start to correct? Well, people go out there and start buying puts without even thinking about it. So I am getting hurt a little bit from the volatility stepping up. Let's take a look at this as to what happened from flip to today. Sorry. We can see the correction happen. I pulled this chart out today right at the close. We can see that it started selling off. Now look at this. Going from what we had on the other one, I was basically, I don't know how I can pull this thing off. Here we go. So let's take a look at right here. So the premiums. And I want you to take particular note actually to this number here, right? Our Vega, coefficient. It was 57.5 yesterday. All right. And we were trading at 222. We've already beat that dead horse. We're also looking at this price right here. And of course, I sold it on the bid with this example. Never do that. Always start out closer to the offer and incrementally move down. It costs you guys nothing to offer it on the bid offer and then incrementally go down. If you just go in and hit the bid, you're probably leaving money on the table. There's tighter markets that you're just not seeing. I'm not going to go into all that, but it has to do with computers legging spreads for us all. All right. And so the premium yesterday, 260, let's call it right in the middle, 265, whatever. It doesn't matter. It's right. 260 is where I got that number. We'll just do that. So the market dropped almost $10, right? I'm going to call it $10 to make math easy, all right? But volatility started creeping up. Now look at the premiums. One day later, I'm going to do a little bit of math here. One day later, we can see volatility increased by 1.5%, right? So our premiums, let's just stream in on this. So we've dropped, again, $10. I'm sorry. We've dropped $10, right? So my premium I talked about was this 65 strike. We can see it's only $1.79. And this dropped $10. So in that meantime, we can see what the delta has done, right? The further away you start getting, that delta starts dwindling a little bit. So within that $10 move, we could say that the average was right around 13 cents. Can we not? Right? Just call it 13 cents there. So $10 downward move, 13 cents. That's 10 times 13 cents equals $1.30. My premiums should have gone down by $1.30. They only went down by $1. Right? I mean, this is pretty close to being exactly $1 down. They should have gone down by $1.30. Where was that other 30 cents? Basically in the Vega jacking up, right? 20 extra cents going in there. That's what shifted it off. Basically, I only got about $1 out of this trade because of the volatility cranking up, pumping up those premiums, offsetting some of those gains there, all right? So not quite exactly, but basically looking at close to 20 cents increasing on that, which is what basically put that in line to only being down about $1. All right. Good there? Everybody makes sense there? You guys, folks, if you had a light bulb moment, please smash that like button for me because that will help somebody else discover this information as well. And hey, if you've enjoyed this and want to participate in the Spot the Trades videos in the mornings when I pop in unannounced, you're going to need to hit that little bell next to the subscribe button because otherwise they're going to give you a heads up. Hey, he's scheduled to go at this time, but I'll probably go in a little bit early when I find something trading. So I'm not always exactly on that time frame. All right. So make sure you guys are subscribing and appreciate the comments for the most part. You guys keep me in line. And here's your probably the last week, folks. We're going to be offering this because we are almost filled up with folks that are participating in this group session here. What we do is we drill down on all the different option components. You guys can reach out to me whenever you want with any questions whatsoever. Yeah, it says during office hours, but my office hours are when I'm in my office for hours. So you can probably catch me. And for $97, listen, folks, if you've had that moment where now you know you should be selling when premiums are high and buying when premiums are low, you know I've saved you $79 in one video. I can assure you I can do that probably every single month for you. All right. So please take advantage of that. Click on that link that I got over there in the window there. Thank you. Appreciate. So if you have any questions or, hey, you guys want me to cover something I haven't covered yet, reach out to us at 310-598-6677 or trading@protraderstrategies.com so I can respond to you guys. I'd love to get your feedback on these videos. It's just going to help me be better for you. All right. So please reach out. That's all I got. Thank you guys. Appreciate you all. And if you can't take that, take it easy. Take care, y'all.